Good morning, everyone. Welcome to this update for global stocks and commodities for the 22nd of October. There was a very minor wobble through the week as traders or computer algorithms or whatever reacted to the Black Monday scenario from 30 years ago. But look, it only lasted an hour or two, and the market got pretty quickly back to trend. So I think that was just something that was that looked like it was engineered to me. So in this particular update, I want to look at the fact that the October crash scenario that a lot of people have been gleefully calling for looks pretty forlorn now. And I think fund managers will be starting to think about the positive run into the end of the year. I want to look at one of the reasons why I think this market keeps rising on such low volatility, which is what's got a lot of people perplexed. There are several facets to that, but I think this is something that plays a major part in it. And of course, let's do a stock and commodity trend update. So we'll start with American stocks. The S&P index was up by 22 on the week, finished on its absolute highs. So it was a very positive session on Friday night. And we had some fears of what happened in 1987 and then the top in the market in 2007 before the 2008 crash, and that caused a little bit of a wobble, but then quickly shrugged off. Major tops, and I guess this is the real message I would like to get across, and I've done this repeatedly, but major tops are always preceded by a change of character in the market. We see a rise in volatility, we get a sudden sharp move, and we'll take a look at the 2007 and 2008 scenario again, just to remind you, but I do it every few months. But there's an increase in volatility. We then get a sharp rebound. There's generally anywhere from 6 months to 12 months to get yourself organized and get out of the way. Market tops are not something to be feared because they can be quite readily spotted from a fair way away. So they're always preceded by a change of character, and at the moment there is absolutely no sign in the market of a change of character. So I'm going to revisit 2007 and early 2008 just for some guidance to perhaps reassure those of you who are a bit nervous. And look, lots of people that I associate with outside the market know what I do, and so they regularly make comments to me about how the market's overvalued and the market must be this or it must do that. And so I know that the general sentiment and general feeling is a bit nervous at the moment. So I just want to kind of put your fears into perspective. The US earnings season is underway. It's progressing very nicely. The banks have come out with pretty good results, so that always is a good underpinning for the market. The next 2 weeks sees in excess of 1,000 US companies reporting, which is the peak period during reporting season. So that will certainly count for a fair bit in terms of market direction. A big picture consideration is that stock yields remain more attractive than bond yields, far more attractive. And at the end of the day, any financial market is a competition between where money can get the best return. That's it. It's no more complicated than that. And when stocks become unattractive compared to bonds, then money comes out of stocks and flows into bonds. It's pretty simple. And at the moment, the disparity in return for risk between those two asset classes is still very, very firmly in favour of stocks. So there is absolutely no reason for money to come out of the stock market, because if it did, where would it go? It's illogical to think that it would go to a less attractive asset class unless people were really concerned about the health of the global economy and the health of the stock market. And that is not the case. As I repeatedly cover in this weekly video, we've now got, for the first time in over a decade, we've now got synchronized economic global growth, with so many countries now in economic expansion. We've got really good earnings growth momentum in many of the countries around the world. It's a very good backdrop to continue to support the stock market, and particularly when the return from the stock market, and I'm not talking capital gain here, I'm talking about earnings yield, when the return from the stock market is significantly more attractive than bond yields. So to my mind, that's open and shut on that particular question. The US dollar strengthened a bit on Friday night, Thursday and Friday, and that was around the possible tax reform that appear that the Republicans are now starting to sing from a single hymn book. It doesn't mean that those tax reforms are passed, but it's certainly a good step forward. And that tax reform is going to be enormous for America. If Trump can get even a part of that through, the impact on the American economy and therefore corporate profits is going to be extremely positive. I think people really underestimate just how much positive impact that's going to have. Let's take a look at some charts. We'll start with the S&P. This is on a daily chart, so you can see we've been in a very powerful trend. The last time we got any sort of retracement or consolidation was in the August 2015 through to June of 2016. So we've got about 12 months there of a sideways pattern, and that bridge between 2100 points and about 1800 points, so about a 300 point range. Lots of people were calling the top in the market at that point in time, but the market has marched on now by another 400 points since then. And yes, this price is considerably above the 50-day moving average, the blue line, and therefore it's extremely vulnerable to a pullback. So it's unreasonable to expect that this trend will just continue as it has done in the last couple of weeks. There will be a bit of a pullback, and we may even see that in the next week or two. But I'll come back to explain one of the factors that I think is causing this very low volatility advance in the market. Let's just look at the VIX index while I'm here, just to demonstrate the low volatility. So this is the VIX index. This was a pretty important floor for the long term on the VIX, came in around 10. But you can see we've now been consistently below that floor with just a few minor little excursions above it. We've been very consistently below that floor now since April, and there's even a bit of a trend down. So we've got this incredible low volatility in the market. And one of the reasons that is contributing to this that makes sense to me is the fact that we've got a high and increasingly higher proportion of global funds that are being operated on what's called a passive basis. In other words, they're just tracking indices. There's not investment managers there making decisions about valuation or the merit of stocks or the likely future. And as a result of that, there's really no one selling. The fund managers are not actively selling. There's still a proportion of active funds, but they're becoming less and less. And so as more and more money goes into the wealth accumulation pool, then that requires more buying, which pushes the index up. And because there's no managers making active decisions or evaluations of the market, then there's no real sell-offs. And that's why we're just getting this continued rise that sort of feeds upon itself under extremely low volatility. It just makes a great deal of sense to me and explains what we're seeing. Now, of course, that begs the question, how far can this run? And I think it can continue to run until we get to a point where stock earnings yields become less attractive than yields from bonds. And we're a long way from that point yet. So I think this dynamic, which to be honest, I'm uneasy about. I don't like to see a market going up, for no good reason. But there are certainly, there are a lot of good circumstances out there in terms of the global economy and corporate growth. So there's absolutely no reason. Is the bottom line of what I'm trying to say here. There is absolutely no reason why stock values cannot continue to appreciate in the manner that they have. Let's take a quick look at some of the other US indices. This is the Nasdaq, just continues to power ahead at the rate of knots that it has been. If we look at the Russell, so the small caps took a big jump up on Friday night. They're basically trading at all-time highs. So the breadth in the US market is really strong. Let me just go back to the S&P and let's just take a look at the character of the market in 2008. So I'll just move this whole slide back here and let's look at what things look like in 2007, 2008. That's probably a pretty good view from there. Okay, so through 2004, 5, etc., you can see the market continue to advance. We had a little bit of a sell-off that occurred in February of 2007. So we got a sharp move to the downside in February 2007. But we got to bounce back up. So that created a bit of a warning bell, if you like. But what you're looking for is after this initial plunge, you are looking for the market to bounce, which it almost invariably will do, and then to come back down and break these lows. So what we would have been looking for, or what I would have been looking for in 2007, early in 2007, would have been a break of those lows. Now that didn't occur. We got the bounce, but then it just continued on to form new highs. Now we got another sharp sell-off that started in July of 2007, and it created some lows down here, so running into August of 2007, so it created some lows here. We then got a bounce, formed a slightly new high in October of 2007, and then we started forming lower highs and lower lows. So this initial sell-off here, that was your warning light, if you like, not necessarily to take action, but to certainly be more careful about what you bought and what price you paid for it. But this was ultimately confirmation, a series of lower highs and lower lows that ultimately broke in January of 2008. So how many, we got a first warning sign here in August of 2007. We then started forming lower highs. So we had further confirmation by December of 2007. And we got ultimate confirmation of a breakdown and a change of character in the market in January of 2008, which was well before the worst of the decline. The worst of the decline was over here in September of 2008. So nearly a year of advance warning before the 2008 crash, and multiple opportunities between August and January to readjust your exposure. So that's why I'm not fearful of major tops in the market, and why you shouldn't be either, because it's these changes of character build up over a period of many, many months. They're easy to spot if you're looking at the right things. And at the moment, let's have a look at the character that we've got here. There is absolutely no change in character. That market is still moving ahead very nicely. But as I said, in the short term, we may see a little bit more downside, or a little bit of a pullback. Aussie stocks, the Aussie dollar was declined on US dollar strength a little bit, but our market put it in another big surge, up 93 for the week. So that's nearly 200 points over 2 weeks. So that was pretty impressive, but I still don't see what will keep driving it higher. The bulk of our market is the four banks, and they've just got plenty of headwinds. And of course, Rio and the major miners, Rio and BHP and Telstra has been on a path south for a long time. So I just don't see what's going to keep driving our index higher. And the best part of our market, of course, is still the small caps. So let's take a quick whiz through our market. So we'll start with the small caps. That's been an enormously strong surge of late. We're still off the highs rather in small caps, but it's getting back there fairly rapidly. Broke above this high point from August of last year. So that part of our market is going along very well. This is the ASX 200, so we'd wound into a very, very tight coil between 5650 and 5800. We've now broken out of that. We might advance a little bit further, perhaps make it up to this resistance at 6,000, but gee, I find I'm hard pressed to see what's going to drive it through 6,000 points. Let's have a look at gold and silver. This is gold on a daily chart. So we had a down week, gave back about $25 on the week, and still really no direction in the precious metals market. That's it on a weekly chart. So we've broken above an important long-term downtrend, but we've been unable to keep the momentum going. Let's look at GDX on a weekly chart. You can see we're still caught within this triangle. Eventually it will resolve. My gut feeling is it will resolve to the upside, but I don't have any confidence about when that might occur. So minor exposure to that sector is really all you should have. So down 25 to 1280. GLD holdings, they're stuck at 853, and I'm just wondering whether there's a glitch with the website that I access this information from, because they've been stuck at 853 for several weeks now. Precious metal stocks, modest decline, but really nothing much happening in that area. Other commodities, copper surge, got up above 320 and then eased back to 314, which was largely about currency moves. But underneath that is we've got some really good demand strength that I think is going to play out positively into 2018 and beyond. Crude oil rose a little bit. It was unable to break through resistance in the $52 to $53 area, but neither did it fall over either. So that I think that's important to recognise. So crude oil is certainly looking a bit more solid now. There's our spot copper chart, came off the highs a little bit. And there's oil, which has been in this 50 to 52.5 range now for about 2 months. So to wrap it up, a minor correction or pause is inevitable. The S&P is well above the 50-day moving average. It's unlikely to keep advancing at the pace that it did last week. But look, we're not there yet. And so hence the title of the slide of this video, and that's stay with the trend. We don't have a pause or correction yet. The environment for stocks is highly conducive to corporate earnings advancing further. That's the bottom line. There's no reason why profits can't continue. And so far, 76% of the S&P stocks that have reported have beaten estimates, which is right up there with what we've seen for the last several years. So the earnings season is going along quite well. So I've explained why I think the market does keep rising in such a non-volatile way. I'm sure there's other factors as well, but I think that's certainly part of it. Action to take, just be a bit more demanding on entries. If you get in on a dip, then that's inherently reduced your downside risk. So I think that's really what you should be looking at doing. And in Portfolio Analyst this week, which I'm getting some fabulous feedback on, I'm going to be going back and taking a look at China stocks, a bit of a review, but there's been some huge moves in China stocks in the last week. So they are worth looking at, that's for sure. Anyone interested in a free trial in Portfolio Analyst, of course, that's still available. So that's it for this week. There's my contact details, and I'll be back with you next weekend. Cheers.